Welcome to the Thematic Edge. I'm Marvin Barth of Thematic Markets and Seriously Marvin. I'm joined again by my good friend Mark Farrington of the Global Watchtower. And we have lots to discuss this week, Mark, because of course, for macro people, this last week was the one of the two big weeks of the year, the IMF World Bank meetings that everybody who's anyone goes to, of course. Just sitting at a cafe, in Washington, you just see like everyone and their mother walking by, Nobel laureates, the whole bit. I was traveling up and down the East Coast, meeting a variety of different client prospects, as well as stopping by in Washington. And I think there's just a lot for us to discuss in terms of what we learn about the consensus. For me, that's a really important part of this because as someone who is sort of unintentionally contrarian, and I think that's a description of you as well. Um,
Yeah.
Now that I don't work on a trading floor anymore, and I'm not meeting with a broad range of clients, it's often hard for me to gauge where the consensus really sits. Um,
hmm
how much have they sort of moved towards my views or otherwise? So that was a really interesting experience. And then, of course, there's what those institutions themselves are, that is the IMF and World Bank are describing in terms of what they see as the developments in the global economy and the risks around them. So I think we'll focus on those. Shall I just start by describing some of my observations off the top?
Yeah, I think so. I'm keen to hear them, and I'm guessing you didn't come back with a message that everyone's bullish on the U.S. economy now, because otherwise you would have started out with that. So yeah, let's hear what you learn.
Well, I mean, look, that's actually what was sort of one of the key lessons to me, and you have seen a sort of upward rise in people's forecasts, and this was even apparent in the IMF's forecast themselves, right? Like,
Yeah.
relative to April, the IMF raised their world forecast for this year by almost half a percentage point, almost a quarter percentage point, just for the US, which was almost the entire rise. In fact, it was the entire rise in advanced economy forecasts. And so I had been thinking that actually, you and I have been, I think, much more positive on what the Trump policies were going to do in terms of economic growth, or
Yeah.
perhaps maybe it's better to describe it as less negative.
Yeah.
I'm not sure. And so I had kind of thought that this was people moving in our direction.
hmm
And what was interesting to me, both in the World Bank, or rather the IMF's forecasts in the World Economic Outlook, their semiannual publication there, and the Global Financial Stability and Risk Report, is that the rhetoric is still very negative, right? They've
Yeah.
kind of reluctantly raised their growth forecasts, but
Yeah.
still projecting, "Oh, but it's still going to be terrible, and the risks are skewed to the downside." And I got a similar, it wasn't uniform among the sort of market participants and clients that I met with. Um, and there was a clear sign that I do get a biased set of information from my clients, right? So
Yeah.
the people who were closest to my views,
Yeah.
you could rank them almost top to bottom, from the clients who have the most interactions with me, the ones who are regularly talking to me in meetings, to the clients who are sort of read-only subscribers, to the people who are prospects, to people who are unfamiliar with my research, is sort of like almost a perfect continuum of whether you agree with me or don't agree with me. And
Mm.
I mean, one of the things I take from that is that's clearly not an unbiased sample of market. So this is part of my problem in judging
Yeah.
where the consensus lies. I don't know whether that's because my clients are the smartest people in the world, or because I'm super persuasive, or just it's bias. People who are already leaning in my direction tend to want sort of self-reinforcing research. I don't think that's the case, but it's entirely possible.
Well,
Um,
I think that at least your views are being repeated now in sometimes in mainstream news, but elsewhere. And so the novelty of the perspective that you brought has maybe faded a little bit, but still possibly people didn't believe the outcomes. And now the outcomes are actually starting to print in terms of data. So I think it's the consensus has to respond to the data, even if they can't respond to the conviction of the argument or something.
yes, so so one axis was sort of this familiarity with my research.
Yeah,
The other axis that I noticed that was also quite interesting and surprising to me is sort of what, at least in the market participants' perspective, is the degree of benchmarking.
yeah,
So one of the things I found is that clients that are benchmarked, what you and I would have called real money clients, i.e., long only institutions that have a
yeah,
performance benchmark that they need to meet, an index like the Wigby or the S&P 500 or whatever. Those clients were much further away from my views and definitely pushed back a lot on
yeah,
the clients or market participants I met with that were on the unbenchmarked or absolute return spectrum. So
yeah.
hedge funds, much more diffuse there, but generally hedge funds and like family offices
Mhm.
were far closer to my views than the benchmark people. I thought that was a really interesting dynamic. Why is there this difference between benchmarked and non-benchmarked here?
That's interesting. I think that we again use Liberation Day as the sort of starting point. All of the US asset classes have mean reverted and, in fact, gone on to new highs in terms of the equity markets and things like that, except for the dollar. So, usually, when you have like one of the asset classes that is still holding out, hasn't done the mean reversion, it allows people to delay changing their view. And I feel like a lot of people who may have got it wrong through the summer and argued that the world was going to end under Trump and that all of its allies were going to abandon it, etc. They can still point to the dollar and they can still point to gold and a few things like that and argue, well, maybe I'm right. But it's starting to become harder and harder to cling to that view. I mean, the growth story has definitely come through. The inflation story hasn't come through, and the performance and the earnings from the corporate sector continue to surprise. So at some point, yeah, I think the capitulation has to come, and people have to start arguing that, we just completely overestimated the risks associated with Trump's policy changes.
It's interesting that you put that there and phrase it that way in terms of like the dollar being the holdout, because the impetus for my trip was I was speaking at a dinner full of institutional clients,
Mhm.
and where I got, it was quite a broad-ranging dinner, and obviously, in the end, I'm focused on what's going on in financial markets. But where
Mhm.
did I get the most vocal pushback on? It was exactly on geopolitics. And
Mhm.
you know, I've you're you're familiar, and I'm probably most of our listeners here are quite familiar with my sort of La Casa Nostra Americana framework that
Yep.
we don't have the global policeman, so you don't have a relationship of niceties now. It's a relationship of power politics, and power politics is ultimately what's driving the sort of global diplomacy.
Yeah.
And that ultimately interests were aligning on a lot of these to line up against China. And the week before, we had
Yeah,
had what, and we might want to talk about this, what I would describe to an old baseball player as an unforced error by China,
yeah,
of announcing these controls or this control system on rare earths that basically put everyone on Earth on notice that,
yeah,
yeah, China has significant power against all of you and is prepared to use it and is not necessarily a good actor. And so it was a very clear offset to the Trumpian power politics that everyone said only Trump was being a bully. You had, Europeans, everybody coming out saying, whoa, we got to worry about this. And yet, the pushback I got was really on geopolitics. So it was interesting that I didn't get so much about, whether it was the Fed, whether it was the US economy doing well, things like that, where there were verifiable facts in the data
yeah,
versus geopolitics, where it's, I guess, less quantitative and
yeah.
less able to say this is clearly going this way or that way. People really wanted to cling to that view that no, this is going clearly against the dollar, which I
Yeah.
think speaks to your point.
Yeah, that's an excellent point. And in our investment process that we used to run, we used to always put geopolitical overlay as the longest time frame. For exactly those reasons, there isn't a cycle of monthly high frequency economic data that allow you to constantly dynamically update your view. Sometimes it takes a couple of years before you get validation of, the first phase or whatever. So, getting progress reports on how the geopolitics are going is not easy. But and you can't just look to the dollar, look to the gold, and say those are the data points because those are not the data points. But your point about China is a perfect one to reiterate. I know I disagreed immediately with a number of people I saw writing in social media and whatnot about this being such a disaster. Look what Trump has done. This proves that China has all the leverage and that they're playing 4D chess and chess, and Trump is playing 2D. The same typical sort of negative reaction. And I had the opposite, saying, no, this is very different because China selected a sector which was non-military across a whole host of consumer goods like automobiles and things like that that just simply have a battery in them. And so the number of people and countries affected by the export controls that China announced was infinitely higher than what Trump had done a month and a half earlier by putting further restrictions on the most advanced chips that companies produce that clearly have military use. So it wasn't apples to apples, and it was a poorly thought out retaliation. And I said, oh well, this is going to backfire, and this is going to play to Trump's hand that he's working with now. So yeah, I was not surprised. I think everyone has realized that very quickly when you saw the Europeans, as you say, bring it up at G7 and things like that, and people suddenly understand that it might play out a bit like the way it did with Russia doing a full-scale invasion in Ukraine, and suddenly convincing Finland and Sweden to join NATO for the first time in,
Yeah.
50, 70 years. So I think it's going to be viewed in hindsight that way, that China overreacted and it pushed greater consensus in the West.
Well, that's exactly why I described it as an unforced error, because I had the
Yeah,
exact same reaction to you,
yeah,
right? Like the fact that they had this stranglehold. If you didn't already realize that, I'm sorry, you just weren't paying attention. Like this was
yeah,
obvious. This has been known for years.
yeah,
And in fact, this is one of the things I wrote earlier this year when they had the potential to use that as a weapon in the
yeah,
trade dispute back in April. I said,
yeah,
look, something is clearly much more deeply wrong in China than we understand. Because the fact that they capitulated, and everybody puts it in terms of the US and Donald Trump capitulated on his, 120% tariffs. That's true. They did walk that back. But the fact that they actually came out with a deal that still disadvantaged China relative to what was before Liberation Day
hmm,
tells you China also capitulated, even though they had clear ability to, or what you might call escalation dominance, right?
yes.
They
So
had
this
far greater power and they didn't use it. Why?
Well, I think this is great that you brought up this point about escalation because I've been having this debate with people since the beginning of the Ukraine war, where everyone was arguing that, Russia is brilliant at escalate to de-escalate and all this type of, hybrid warfare vernacular that's so popular. And I made the point that with critical minerals in particular, it's not a technological hurdle. We all understand what the refining of critical minerals hurdle was in the West. It was always environmental and labor related. So, how do you get amendments to your domestic restrictions on environmental issues and labor issues? Threat of geopolitical economic warfare against you.
Yeah.
So now China has probably created the impetus for the Congress, should it ever go back to work, to amend legislation and allow a lot of the type of refinement that needs to be done for critical minerals to be done. And so this is what I mean. It's hard for the West to escalate because a lot of their restrictions are self-imposed. But
Yeah.
as soon as some external, rival attacks them, then they immediately get the parliamentary or congressional right to respond.
Exactly, which is exactly why I saw this as an unforced error, right? In that I actually think is more important. The U.S. was already moving in that direction, right? Uh, it's the rest of the world, and in particular the Europeans, who were resistant to this idea that they were in a state of economic warfare
Yeah,
or under threat from it, that have now been put on clear notice. And that's what I thought was that's why I described it as an unforced error,
yeah,
because it's a little bit like if you're going to get into a bar fight, you don't get there right in someone's face and like, oh, you want to go outside, whatever. No, you just pop them, right? You hit them, right? If you're serious about it, you hit the person.
yeah,
And that isn't what China did. They got up in their face and warned you that this is an issue, but then backed off. Again,
yeah,
just like in April. Why aren't they willing to go through with it? And I think there is some clear vulnerability, but the very fact that you put the people on notice was a huge error for them because, to exactly your point, it basically helped the Trump administration get everybody on side with
yeah.
them to say, oh, well, yeah, this is actually a vulnerability. We'd better deal with this.
Yeah, no, exactly right. So then tell me, like, wh why do you think that in your meetings in Washington and New York and Boston and places like that, why aren't these type of events having as much effect in changing people's mind about the Trump grand strategy as it is obviously having effect on like high frequency economic data changing their view on growth and inflation. They seem they don't seem to be convinced on the geopolitical side, but they are reluctantly, acknowledging that maybe they were overly bearish on the economic side. So
Well,
what's missing?
I mean, look, I think it does come down to once you have a narrative in mind, it's really hard to change it. And there was just so much invested, particularly in the institutions,
Yeah.
in this, that the sort of path that we were on before made
Hmm.
such sense that we shouldn't deviate from it, or any deviation from that is a threat. You would also have to admit error, and I think this is one of the things that even in the acknowledgement in forecast that growth is going to be better than expected, um,
Hmm.
there was a clear uh, message of we're not wrong though. We weren't wrong to forecast something bad happening because it's still going to happen, or there's risks of it's going to happen. So I thought that the IMF's World Economic Outlook, I mean, it was almost comical in the way that they did this, right? Like, they've revised up their forecasts
Yeah.
as I described earlier, and yet, they actually said in their forward, it's really good. You shouldn't take from this that tariffs are not going to be very destructive. It's
Hmm.
only that they're going to come later, which, by
Hmm.
the way, they revised up their forecast for next year. So when is this later going to come? Apparently in the second half of this year. All of a sudden, the tariffs are going to hit in the second half of
Hmm.
this year, even though they misforecast it in the first. But also because there were all sorts of offsetting factors that you could never have foreseen. Like, the AI boom that's been going on for 3 years now. Nobody could have ever foreseen that that would continue. Or they had things like, the very accommodative financial conditions. I was like, well, really, weren't they more accommodative at the beginning of the year? Um,
They actually have gone to new lows and or new highs, depending how you look at your financial conditions index. But now, thanks to the stocks going to new highs and the dollar being weak, we're actually financial conditions have been easing all year. You should be revising up your growth forecast on that factor alone. I don't understand why the market hasn't marked to market to that trend.
Well, I mean, there were offsetting directions. Yeah, stocks were higher, dollar was lower, but you had a significant deterioration um, uh, in the post April WEO period. Like, they were quite easy at the beginning of the year. So why all of a sudden do you think this? Or things like, we're going to get more fiscal policy out of Europe. Again, you knew this. This was already known
Mm.
a month before the April WEO that Germany had passed this fiscal program. So all of these things were actually known data. And I do find it really interesting that they think just somehow miraculously all these tariff effects are going to show up in the second half. When if you look at the data that we have in hand, right? So
Yeah,
the IMF projects that US growth this year will be 2%.
right.
If you take the Atlanta Fed's current nowcast for the third quarter of 3.9%, that means that the average growth rate through this year, including negative growth in the first quarter, is 2.4%. The only way you
Solid.
get to 2% for the whole year is to have 1% or less growth in the fourth quarter.
Yeah.
This just, but then they have growth accelerating again next year. It makes no sense. And it's very clear they want to say, we were right and but the data are telling us we're wrong, but we're just not going to admit it. And that to me has to be some sort of bias inherent that they're unable to walk back. That's the only way I can explain it.
It's
Uh,
interesting you make that point that way because I don't often read the whole thing. I read first couple of chapters on the WO, but I was surprised when they both characterized the front loading due to tariffs both
yeah,
as negative and positive. So somehow they're arguing that it's borrowing from future growth outside of the US, and then they don't talk much about the payback you're meant to get for GDP as a result of the surge in imports in the US. So I think I can't wait for 2025 to be over because then in 2026, I think that everyone will just forget trying to predict the tariff effects. I think the tariff effects are just not as big of an issue as all the industrial policy driven and capex driven engines of growth. But everyone is so locked in to their tariff effect forecast of 2025, they keep shuffling the quarters. We just need to get it over with because it's distracting them from the overall picture.
so I want to come to 2026 because there's an interesting thing that we brought up. I think it was in our previous episode or maybe two episodes ago. But before I go there, I just want to give you my favorite example of them tying themselves in pretzels to try and justify their mistaken forecast before, which was one of the quote offsetting factors that they
Yeah,
say is why they missed how strong growth was that the Trump immigration policies had limited labor supply.
right.
Again, something that was well known before the April wheel. But even better, they said that was met by a drop in demand for labor. Now, there's no explanation for where that drop came from other than they just magic it out of the air that it's a cyclical pressure. But just think about that. They're saying the reason why we missed our upside forecast in growth is because labor supply and labor demand were constrained. Now, I don't know about you, but I'm unaware of any economic theory, evidence, empirical evidence otherwise that would be consistent with labor supply and labor demand being restrained, and yet you're getting stronger growth. But that's actually one of the explanations they give for why they missed their forecasts. It's
Yeah, you're right. Pretzels, tying themselves in pretzels is a good way to put it because, like I said, it was such an unfamiliar event, and the front loading in Q1 was so immense. It just put everyone on the back foot for the rest of the year to try to forecast the quarter on growth. And all of the labor market revisions that came through in June and July messed with everyone's forecasts. And so, I mean, it just feels like 2025 is a year where there's too many data anomalies. And this is why I've kind of mean reverted to looking at financial conditions as a much better, you know, trend line to track whether risk assets will continue to perform in line with what I assume is a strong economy, in spite of the way that it's being described. And I think that makes it look a little more consistent. Financial conditions easing through the summer help support the recovery and new highs to equity markets until we finally got that Q3 GDP number to show like how strong the economy is, and then we didn't have to guess anymore. So why they would expect a fourth quarter drop off from here is pretty hard to understand. But at
well,
least now
it's also the
Q3
question.
data helped.
It's also the question if you just look at the data, right? So, yes, there was this front loading, but I think this is the thing that is more mystifying to me is the lack of acknowledgement of the accelerating momentum in real indicators since then, right? Like if you look at whether it's, second quarter CapEx was still blisteringly strong. Like it was a slowing from the front loading as you talked about in the first quarter, but
Yeah,
relative to almost anything else, it was blisteringly strong.
right.
Since then, all we've seen is rising core capital goods orders. We've seen consumption accelerating. Everything is telling you the US economy is actually accelerating. Even
Mhm.
inflation is telling you that. The only thing that is a potential negative indicator is this idea that employment growth is slowing.
Yeah,
And that's one of the ones that I find most interesting. And I um uh the sort of official sector meetings I had um really surprised me on that one in that I've done this research looking into whether the slowdown in employment growth is supply driven or demand driven,
yeah.
and the you know analysis I do very clearly falls this is a supply driven slowing in growth, which yeah, that restrains the potential for
Hmm.
US growth, but it doesn't suggest downside. It suggests upside risks to growth
Yeah.
in terms of, capital substitution for labor. The other thing that I thought was really interesting is in that piece highlighting how big an issue what is called solopreneurship, people like you and I who basically work for ourselves.
Yeah.
Um, and what a big source of employment and actually what the income gains in that area are. It's not just the gig economy. There's a lot of seasoned professionals who are going out and actually increasing their wages by going solo. And
Mhm.
um, what was really interesting to me is in my sort of official sector meetings, how completely unaware they were of this phenomenon and how
Mhm.
big it was. So I got like, it wasn't pushback in that you're wrong. It was more questions like, I can't believe this. Really? It's that big? Are,
Or
are,
how
are you
big,
kidding
yeah, how
me?
big it is. Yeah.
And yet, when I calculate the numbers there, and remember, that category will not show up in non-farm payroll in the establishment report. And
Yeah.
when I calculate the numbers on it, it's big enough that it absorbs all the potential labor force growth. So in reality, non-farm payrolls should, in full growth with full employment, should actually be running at zero right now under some of my calculations.
Yeah,
And
actually, when you brought this up last time, it made me think, and unfortunately, I didn't follow up. What about the ECI? I remember, does the ECI capture, labor costs that will become more useful going forward as a result of having less non-farm payroll growth, but still a relatively tight labor market that we can't capture? Will it show up in maybe higher ECI index readings, or is that also not drawn from the right data?
it should, but I'm not sure how they deal with this solopreneurship. It will better handle a lot of other aspects that we're missing, but I'm sorry, I just don't know the answer to that.
No, no, I just it got me thinking last time, and I should have followed it up because I think you're right. Non-farm payrolls is not going to be a very useful indicator going forward. I mean, we've had all the revisions which has caused the issues already, but uh, the type of labor that we lost through illegal immigration workers going home is mostly in the non-discretionary space. So, like, it should not be a limit on growth. It should just be inflationary. So, it's the loss of labor, excess labor in the discretionary consumption space where maybe businesses would just agree to cut back on size of operations and things like that. So the story doesn't match up. I just think we need different indicators to track to get a handle on labor.
This is exactly my point about, like, this isn't the gig economy, this is the solopreneur economy.
Yeah,
And when you look at the data, what we're talking about is our most productive workers,
yeah,
people, mid to late career who are the most skilled, most seasoned, are going out on their own and actually making more outside than they could inside.
yeah,
And to your point, the labor constraint, to the extent that we're talking about immigrant labor being restrained,
yeah,
that's really much more a story about less skilled workers being
yeah.
restrained, um, which is really all about raising the cost structure in the economy. That will show up in the employment cost index.
Okay.
It's showing up in wages as well. And so it suggests that it's not about growth being restrained, it's about an upside potential in inflation, far more so than from tariffs, by the way. And that's the point that I wanted to return to about the 2026, which is, if you recall, whether it was our last episode or the previous episode, you'd actually raised this point. You said, hey, it looks to me like the unexpected story, the story that's going to dominate 2026, that is going to surprise people, that people are not prepared for, is inflation. And I have to say, given where the Fed is going with policy, the fact that they've guided us that they're going to cut again, despite the fact that, there's very little evidence that rates are restrictive. If anything, I would say they're actually stimulative at these points, that inflation is accelerating and that they're completely missing this whole employment piece over here. And again, like, I got a
Hmm.
very strong impression from various meetings I had, they're missing this.
I
Um,
think I can't express how concerned I'm about this. I flagged it in my last Dollar Watchtower report that now, in my opinion, the driver of the dollar into the year end now is much more driven by what I hope will be a reversal in Fed expectations. Because It's 100% price for 75 basis points rate cut between now and the end of the year. It's just an insane path that they're forecasting, and so somehow that has to be moderated. I don't know what can trigger the moderation, but while you have such an aggressive Fed cycle discounted, it actually trumps the external risks from geopolitical risks that I've been flagging for the last 2 quarters as the potential upside drivers for dollars because it's extreme. And if you look at the way the relative currency markets have performed since the Liberation Day shock, the currencies that have managed to retain their gains against the US dollar are all those currencies which are trading off of the relative Fed interest rate outlook. So, like the Bank of England and ECB in particular, they've held their gains, and the Scandinavians, etc. All of the other currencies where they had a quite aggressive easing cycle or they were exposed to China growth downgrades, they've V-shaped, mean reverted again against the dollar as the Fed held rates unchanged through the summer. But now the Fed's cut rates once preemptively and forecast to do back-to-back rate cuts at the next two meetings, with the December rate cut being 50 basis points. I mean, this is really discounting a scenario that I can't see anywhere on the horizon, unless people imagine that the credit event that is starting to bubble a little bit is going to tip the Fed's hand. But it's pretty early days to project that, private credit event blowing up, certainly blowing up between now and December and pushing the Fed's hand. So I'm perplexed by this forward Fed funds view that's in the market.
Well, I would say, look, on that, I mentioned before that, where I saw the most agreement was from people who, subscribe to my research, and in particular, people who have the most interactions with me. And that doesn't mean that there wasn't a lot of pushback from those people or like active discussions, but it was really interesting. The one view where they were most strongly aligned is this idea that 1 year forward rates are totally mispriced,
Yeah.
because there's generally an acceptance among all of them that indeed the Fed is making an error here, but they're going to keep digging that hole, and they're going
When,
to put
when have they
themselves.
ever done that? I don't know where people get that confidence. The Fed has never run 3 meetings in a row in the wrong direction. They might go one,
Well,
but
hold on. I would argue that they've been going. I mean, come on. I think go back to the September cut, 50 basis points out of nowhere for no potential reason.
they didn't follow
Yeah,
it. My point is they didn't follow it up.
but they did, right? They cut two more times.
They,
That they
they
did
cut
take a
twice, I
pause
thought.
through the first half of this year, right?
Yeah.
But now they're like continuing on that. The fact that they haven't internalized still that all of that was a mistake and that they're still running forward with this. I could imagine if they had actually done, this September's last month's cut, and we're talking about this month's cut back in spring, when
Hmm.
actually inflation data were cooperating with them. When for the
Yeah.
first time in this cycle, I actually started to question whether maybe inflation was coming down. But the fact that they're doing this now after we've seen clear evidence that the economy is accelerating and that inflation is accelerating, and that the
Hmm.
only thing that they can stand on is labor markets, and that they themselves, even in the press conference, acknowledged that there's a potential supply aspect to this.
Yeah.
Like, I don't think markets are crazy to continue to price rates lower, but the point is that you know all the people I was talking with who were more aligned with my views, this was where they'd all were most strongly agreed that these guys are making a mistake and
Okay.
that they will have to reverse it hard
Yeah.
next year.
Yeah, that's
It's
interesting.
a mistake.
They may have that view, but the yield curve and
Doesn't price
spreads
that. You're
and
exactly
yeah,
right.
isn't showing that they
Uh,
have this consensus the Fed's making
well,
here.
as I said, it's not a consensus view. I'm saying of the people who agreed with me, that was where they were most strongly agreed that this is an error that the Fed is making, and that they are going to have to come back hard next year.
Yeah, it's been worthwhile to watch the speeches that from all the Fed the FOMC members that have come out since the rate cut, and all of them express some concern on one area or another area. Even the ones which think that they should continue to cut. It's not with high conviction and listing a string of caveats. So, when can you remember in Fed history where there isn't conviction and then the Fed does three meetings back to back, 100 basis points cut when you're growing at trend? I cannot remember any period in history when they've done that.
Yeah, and look, they have been even Powell, after the last cut came out
Yeah.
and, gave some, caveats that you shouldn't be expecting. So I tend to agree with you that they're not going to continue um, indefinitely, but
Yeah.
it is also the case that you can see very clearly with this FOMC,
Yeah.
uh, which you and our other listeners are well aware of my views of this particular FOMC and their place in history. But
Powell's not going to get a statue in the piazza, is
I'm
he?
I'm I'm gonna throw the whole committee. Like, I mean, it takes a committee, and frankly, like one of the things that's been a defining feature of this committee. I mean, it's generally been an evolution in this direction, as you know,
Mhm.
but a defining feature of this particular committee is that they will never surprise markets, right? They loathe the idea of, so the fact that they haven't guided you away from this rate cut that's priced in the this month's meeting is telling
Good
you
point.
it's going to happen.
Yeah.
What will be interesting is we get CPI, what I guess Friday, I believe.
Yeah.
It'll be interesting to see if you still have an acceleration in inflation. This is the only data they have in this whole, um, U.S. Data blackout period in terms of the problems at BLS and the government shutdown. If that shows continued significant acceleration, do these guys do we get a Nick Timros article next week saying,
That's a fantastic point because I hadn't even considered that. But with the government shutdown, it also argues for pausing and taking time. I just can't, I cannot,
yeah,
uh, I cannot rationalize the conviction that's priced into the forward curve with the way that the conviction is being expressed by the FOMC members or the environment we're in.
yeah.
So actually, I would fault the market more than the committee at this point because they're
Oh,
pricing in this aggressive view
well,
fully.
but you and I mean, look, this goes back to the inflation point, right? Like, there's there's no way to get around this that break evens from 1 year forward out the entire curve should not be priced at their 2010s average,
Yeah.
right? If either one or two things is going on here, either this Fed is going to make it or is making serious policy errors, which I'm firmly convinced of, or actually, everybody's worries about Donald Trump, putting stooges in the central bank and monetizing the debt. You know, you got to pick one or the other of those, and neither one of those are consistent with break-even inflation pricing.
Yeah.
Neither one. So
Mm.
where are markets on this? Where I come back to the question we've asked before, where the heck are the bond market vigilantes? Because they're clearly not visible in market pricing.
Yeah, that's a good point. You know, I didn't have a good answer last time you asked me a couple months ago, and it's still more or less the same. I think there is a relative flight to quality flow that is holding treasury yields down, and that's why you're not seeing it there. But it's no explanation for why we're not seeing it in non-risk-free assets. It should be showing up there. I see the policy error risks only rising, and I'm not sure why the rest of the market doesn't want to price that.
Yes.
And not just the Fed, actually central banks across the world. Like there isn't a hard money central bank out there in the world distinguishing themselves right now. I gave you
Uh-huh.
I, do you know
S&P.
one?
Well, I mean, look, given the level of their policy rate, you'd say it's not the SNB. But if you look at their inflation rate and you look at
Yeah,
what's happened to their bond market, right?
yeah.
Like their bond market is telling you more clearly than anyone else that they actually have credibility, right?
Well, of course, they've got a shrinking debt to GDP for the last 5 years, which no other country in the world has, and they have deflation again. So that's why I didn't use the SMB as an example because they took interest rates back to zero and said they were going to go negative. So that's not exactly my definition of a hard money central bank, but they're in the strongest relative position globally. I'm just saying that I feel like the inflation targeting regimes have all been discredited and they all need dynamic change. And we haven't, done enough research and reflection and had those changes implemented across the G10 several central banks yet. But that's coming. And we have these convoluted arguments about transitory, non-transitory, and a lot of people, just like you, as you mentioned, with the same with the IMF, just unwilling to admit how wrong they got it, and therefore still trying to spin what they've done over the last 2 years. And I put BOJ in that category. I mean, the debate about underlying inflation versus headline is ridiculous. We're 3 years above target. It doesn't matter. And by the way, one of the dissenting central bank board members gave his speech today and flagged exactly that point that it's time for us to pay attention to headline inflation because we've spent 3 years above target. First time I've ever heard a BOJ official say that. So he also, paid a little bit of respect to the underlying inflation argument, but he said, look, you can't ignore headline inflation so far above target for 3 years. So this, I mean, the central banks they've kind of negotiated themselves into a corner, and they're not showing too much, cleverness in getting out. And the market is not punishing them very much. And if they are punishing them, it's mainly through asset allocation away from fixed income and fiat to equities and commodities. That's the kind of tilt that they've done in their balance sheet that can be described a little bit as vigilante or a little bit of a protest towards the hard money central banker view.
It is still amazing. Look, we should also run down, I think, some of the risk cases here, and
Okay.
um, the IMF, the World Economic Outlook lists some risks, but I think the ones that generally get more attention are the risks from the Global Financial Stability Report. And the key ones that uh, they cite are valuations, particularly in the tech sector, and a potential sudden cessation of investment by in artificial intelligence, which is kind of a funny one to talk about. There's also a lot of worries about the banking system,
Mhm.
non-bank financial institutions. A lot of this stuff, I mean, I just look at it as uh, this is an entity, this capital markets group who produces the global financial stability uh, stability report as a hammer. Everything's going to look like a nail. They have to say there's all these risks out there that we need to go hammer. Because there are things like in their banking sector stuff. One of the most ridiculous things they flag is this increasing dispersion of risk-weighted assets in
Yeah,
the banking system. And then you look at what they're talking about, and the median and average risk-weighted assets are falling for banks.
yeah,
And the dispersion is widening, but it's widening from the bottom. I.e.,
yeah,
you're not getting a bunch more banks are moving up into higher risk-weighted assets. You're actually getting lower.
yeah.
So, I mean, there's crazy things there, but there's definitely, I think they focus a lot on this, the connection between non-bank financial institutions and banks and how that might be a propagating channel. So, I mean, look, in the like 10 minutes we have left, let's discuss these two risks. Let's start with the one about uh, um, the AI bubble, because
Yeah,
this
yeah.
it's gotten a lot of discussion. And I have my own views on it, but I mean, where do you stand on this one?
Yeah, I think that what I've seen written on the comparison to the tech bubble, the 2000 tech bubble, um, is useful, and it's the right analog for us all to be considering. But I don't find like the granular analysis to be that impressive. And one of the omissions that struck me immediately when I read through them was so little talk about the Y2K phenomenon. Because what I remember about 1999 was this hysteria that the market managed to instill in everybody's mind, corporate America, corporate Europe, etc., about how the world was going to end because we don't have a four-digit clock in all of our technology systems, and so the world was going to come crashing to an end. And this created this kind of forced capex pressure around the world, compressed in a 12-month period, that was a real economy, real earnings, powerful growth engine story amid all of the fluff and bubble aspect of the internet and e-commerce part of the tech bubble, which hadn't yet produced any earnings. So, I mean, the Y2K beneficiaries, the IBMs and Cisco and SAP, these companies, they shut the lights out because they got so many orders during that period, that it was a real growth story, which might look a little bit like the constant earning surprises that we see from Nvidia and TSMC now. But that hit a cliff when we all woke
Yeah,
up,
exactly.
after January 1st, and the world didn't end. And the first turnover of a peak in capex, largely driven by that Y2K phenomena, was treated as the sell signal, and that kind of happened a little bit before the earnings misses in March 2000. That really started accelerating the sell-off, and then the harsher lens put on all of these internet startups that had no earnings. So I think that that's missing from this particular AI bubble. We don't have this time compression forced capex story. We have this open-ended AI capex story, which is broadening, and as you always like to point out, is a national security
Yes.
imperative, and you have the government behind it. So it does feel like it has more time to run. I just am now very much interested in see if I can find a similar cliff risk as that Y2K one, which was driven by a calendar event. I don't know what you think about that.
Well, so look, I agree with you. I think while there are definitely some parallels to look to here, this is a distinctly different one. I love your point about Y2K. I had forgotten about that, and that is so true. I remember there was so much investment around exactly it. And to exactly your point, once you pass that calendar date, it's all done. There's no need to do it anymore, right? I don't see a similar sort of thing in the AI thing. As you alluded, I've written about this before about, the geopolitical risks are very different in the white or in the dot-com bubble. All of the competitors were in the US. You weren't worried about somebody else leapfrogging ahead of you. That's not true now. No country or the two key competitors in this race, the US and China, cannot afford to allow the other one to get ahead. So there will be a level of government intervention and support for this that wasn't there then. In terms of and also, by the way, I think the other like fundamental point is that you're right. There were the IBMs and Cisco's and people making semiconductors who were actually earning a lot of money during that period. But there was a huge swathe of companies that were getting crazy valuations that literally had no earnings and were not getting earnings. One of the things that's been really interesting about this one that's very different is that as fast as the valuations have been galloping
Yeah.
for these firms, the earnings have followed, right? Yeah, they follow with a lag, so your P ratios still look edgy, but
Mhm.
actually as the GFSR, if you read through the details, even though they highlight about price earnings ratios, one of the
Yeah.
things that they also show is, price earnings ratios embed an interest rate component.
Yeah.
And the real measure of equity risk is the equity risk premium, the difference between the earnings yield and the real interest rates that are discounting these equities. And they actually show that this year equity risk premium has actually risen, right? So it's markets are not pricing the same craziness that they did then when equity risk premium actually went negative, right?
Yeah.
So that's one big thing. But I think to your point about what is this cliff edge thing, I don't think it's a specific calendar event. I think it's a political event.
Yeah.
And
Okay, I think you're right on that.
I suspect it's not AI. I suspect it's ESG and energy, right? We've already seen the Trump administration pivot away from that, but there's still significant swathes of the US economy that are not accepting that. The Europeans are very strongly not accepting that and still going down the path of ESG and green energy. And frankly, in this competition, especially in the AI world where it's so energy intensive, you're just
Yeah.
not going to be able to compete with China with those policies. And so, whatever your views on the environmental merits of these, it's not going to matter anymore. For
Yeah.
pure geopolitical, national security reasons, all of these countries are going to have to pivot away from those policies. And there's been a tremendous amount of investment in that area, and it's all going to go flat.
I think you've put your finger on it perfectly there because coincidence or not, it does seem that those politicians currently in office that are somewhat politically aligned with Trump's worldview simultaneously support, pretty aggressive geoeconomic policies against China, and we have to go and expand energy on every single component, green, alternative, as well as fossil. We need to ensure that our energy supply lines are strategically safe as well. So it's probably a political pendulum shift somewhere where you have new politicians who come in and accept, across the board policy change. And in Europe, that most important one would be the green energy one. And that would free up a lot of resources for other areas of government spending for sure.
Yeah,
But that's a
so
big change.
we're actually almost exactly at an hour now, but any quick thoughts on this other issue of non-bank financial institutions and their link back to the banking system? I mean,
Yeah, I think you always make the good point that they're small relative to the size of the bank balance sheet because we have allowed the too big to fail banking in banks to become so gigantic, enormous that the private credit area is going to look small in comparison. But they've done the same naughty things that they did in the past ahead of the global financial crisis, where they're taking things offshore in their subsidiaries to circumvent the leverage and reserve requirements in their main countries, and they all have credit lines with the banks. which, maybe the banks can cut the credit lines, the revolving credit lines quickly enough in the event of a crisis. But that's how the global financial crisis happened as well. It was peripheral institutions that were falling, and they start the contagion, and then they maybe all end up aligning with a cluster of one of the major systemic banks. And then if the Fed or the ECB or whoever is unable to ring fence that one, then you get the contagion to the rest of the banking system. But yeah, it doesn't feel like there's any systemic risk to the core banking systems, but it does feel like a lot of non-bank entities, particularly life insurance companies, private equity, and hedge funds, have bought some very poor assets that have been underwater since the 2022-23 inflation episode that drove rates up, but they haven't tried to liquidate their portfolio. And now people are trying to liquidate their portfolio for the first time, and we're seeing what the mark-to-market damage actually is. And that's making us question all of these non-bank financial companies' balance sheets. And I don't know how big it is, but it's certainly, as Mr. Diamond said, there's definitely more cockroaches out there to be seen.
Yeah, I am sure that there's a lot of losses yet to accrue. I do have a lot of suspicion, or I do have a lot of skepticism that this is at this stage a systemic risk, simply just because, you know, even when I see people trying to hype up the story and like present numbers around this, and they put them in dollar terms, and you
Yeah.
go out and think about what those dollar terms are. Like, there's one report, I actually think it was you who forwarded it to me, that was saying, there's $500 billion in bank exposure to these private credit, and you know caveat that with, oh, those are all secured by commitments, capital commitments from their pension fund investors and things like this, which again, yeah, if you have a cascade, yeah, some of those would come up. But then you put that 500 billion global exposure to the banking system in context. That's 1/10 of JP Morgan's balance sheet. And that's just one bank, right? I mean,
Yeah.
it's hard to get to a systemic crisis from there. That's not the case that we had in 2008, where, yes, we didn't have transparency at all into how big those exposures to the banks were.
Mhm.
And that could be hidden here too. I'm willing to admit
Mhm.
that. But, you know, the fact was the numbers were definitely a problem.
Yeah,
This
the numbers were bigger for sure.
it's not clear. So look,
Yeah.
I think we should call it quits there. This has been another fantastic discussion. Thank you for making the time, Mark, and we'll pick it up again in 2 weeks.
Yeah. Yeah. Good to have you back from Washington. See you soon.
Take care.